The United States does not plan to repay its national debt. That statement sounds extreme, but it is mathematically grounded. The U.S. national debt exceeds $30 trillion. It continues to rise every year. Interest payments alone now represent one of the largest federal expenditures. And yet, there is no structured repayment plan. No sinking fund. No long-term amortization schedule. No political consensus for surplus. This is not because repayment is forgotten. It is because repayment is structurally incompatible with modern fiscal reality. Governments do not operate like households. They do not eliminate debt in full. They roll it over. Old debt is replaced with new debt. Maturing bonds are refinanced. Deficits are added to the total. Debt sustainability is judged not by size alone, but by serviceability. As long as interest payments are manageable relative to revenue, the system functions. But here is the problem. Debt has grown faster than GDP. Interest rates are higher than they were a decade ago. And structural deficits are persistent. If debt grows faster than the economy that supports it, arithmetic tightens. This episode is not about collapse. It is about inevitability. Because repayment, in the traditional sense, is no longer realistic. Instead, governments rely on four mechanisms: growth, inflation, financial repression, or restructuring. Understanding which path dominates defines the future. Debt arithmetic: why repayment is structurally impossible. National debt functions differently from consumer debt. Consumers must repay principal over time. Governments typically roll over principal and pay interest. If GDP grows faster than debt, the debt burden shrinks relative to the economy. This is the ideal scenario. But sustained primary deficits change the equation. When government spending exceeds revenue excluding interest, debt compounds. Interest on existing debt adds to the total. The compounding effect accelerates when interest rates rise. Consider this simplified structure. Debt equals principal. Interest equals rate times principal. Deficit equals spending, revenue. If deficit remains positive and interest grows, total debt rises automatically. Now consider scale. If debt exceeds $30 trillion and average interest costs rise, even modest rate increases translate into hundreds of billions in additional annual payments. Interest expense becomes one of the fastest growing budget items. When interest payments grow faster than revenue, fiscal space shrinks. To repay principal meaningfully, the government would need sustained surpluses. Large surpluses. For decades. Political reality makes that unlikely. Spending commitments include social programs, defense, healthcare, infrastructure, debt service itself. Reducing spending enough to generate large surpluses would require structural political agreement. Raising taxes sufficiently to offset debt growth would require similar consensus. Neither path has demonstrated long-term sustainability. Therefore, repayment through surplus appears implausible. This leaves growth. If economic growth accelerates above debt growth, ratios stabilize. But growth in advanced economies tends to be moderate. Demographics limit expansion. Productivity growth fluctuates. High debt levels themselves can suppress growth through crowding out effects. So repayment through growth alone becomes increasingly difficult. This does not mean default tomorrow. It means repayment in nominal terms is not the operating goal. The operating goal is sustainability. Sustainability depends on market confidence. Confidence depends on interest rate levels and monetary credibility. If rates remain moderate relative to growth, debt can be rolled indefinitely. But if rates exceed growth persistently, arithmetic becomes restrictive. This is where the debate intensifies. And where the next mechanism emerges. If you cannot repay, you inflate. When repayment through surplus is unrealistic, governments turn to the second path. Inflation. Not hyperinflation. Not currency collapse. Gradual erosion. Debt is fixed in nominal terms. If inflation rises, the real value of debt declines. The principal remains the same in dollars. But those dollars buy less over time. If wages and nominal GDP rise alongside inflation, the debt-to-GDP ratio can stabilize or decline. This is the quiet method. After World War II, many advanced economies reduced debt burdens through a combination of growth and inflation. Debt was not repaid directly. It was diluted. Inflation is politically controversial. But it is historically common. Moderate inflation reduces the real burden of fixed-rate debt. If inflation runs above bond yields for sustained periods, creditors effectively receive negative real returns. This transfers wealth from savers to borrowers. Governments, as the largest borrowers, benefit. But inflation carries trade-offs. If inflation becomes entrenched, interest rates rise. Higher interest rates increase nominal debt servicing cost. If rates rise faster than inflation, the benefit disappears. Managing this balance is delicate. Now consider the modern constraint. Inflation surged globally in recent years. Central banks raised rates aggressively to restore price stability. Higher rates increased government interest expense. This creates tension. The very tool used to fight inflation increases fiscal strain. If inflation falls and rates remain elevated, real borrowing costs increase. If inflation remains elevated, political pressure rises. Either path complicates sustainability. Inflation can erode debt only if it remains moderately above interest rates for sustained periods. If bond markets demand higher yields to compensate for inflation risk, debt servicing becomes more expensive. This is where credibility matters. If investors trust monetary policy to contain inflation, bond yields remain anchored. If trust erodes, yields rise sharply. Rising yields tighten fiscal conditions further. There is another layer. Inflation reduces real debt burden, but it also affects households. If wages lag inflation, purchasing power declines. Declining purchasing power affects consumption. Reduced consumption slows growth. Slower growth weakens tax revenue. Weak tax revenue increases deficits. Deficits increase debt. The system loops again. Inflation is not a free solution. It is a redistribution mechanism. It shifts cost to holders of fixed income assets. Pension funds. Insurance companies. Bond investors. Foreign central banks. If those holders demand compensation, yields adjust upward. Adjustment raises refinancing cost. Now consider refinancing risk. U.S. Treasury debt has varying maturities. Short-term bills. Medium-term notes. Long-term bonds. As debt rolls over, new issuance reflects current interest rates. If rates are higher than when debt was issued, interest expense increases over time. This creates a delayed effect. Even if rates stabilize, the average cost of debt can continue rising as older low-rate bonds mature. Inflation must exceed this average cost to erode burden meaningfully. Otherwise, debt service grows faster than nominal GDP. This is the constraint. Inflation can help, but only under specific conditions. Too low, and debt remains heavy. Too high, and rates spike. There is also political tolerance. Sustained inflation erodes real wages and savings. Voters react. Policy shifts. Central banks tighten. Tightening pressures fiscal sustainability again. Governments must balance growth, inflation, and debt dynamics simultaneously. This is not simple arithmetic. It is dynamic equilibrium. The US dollar remains dominant globally. This provides flexibility. Global demand for treasury securities supports borrowing capacity. Reserve currency status reduces immediate pressure. But reserve status depends on credibility. If inflation undermines credibility, global demand may adjust. Currency depreciation may occur. Depreciation can increase import costs. Higher import costs fuel inflation. The loop complicates further. So inflation is not an escape hatch. It is a managed erosion. It works only if inflation remains controlled, bond markets remain cooperative, and growth remains steady. If any of these break, the path narrows. Which brings us to the third mechanism. Financial repression. Financial repression, the quiet containment strategy. If repayment through surplus is unrealistic, and inflation alone is unstable, there is a third path. Financial repression. This term sounds dramatic, but it describes something subtle. Policies that keep interest rates below economic growth. Policies that encourage or require domestic institutions to hold government debt. Policies that manage capital flows. Policies that shape savings behavior. Financial repression does not announce itself. It embeds itself. After World War II, many advanced economies used forms of financial repression to reduce debt burdens. Interest rates were kept artificially low. Banks were required to hold government bonds. Capital controls limited cross-border flows. Inflation modestly exceeded bond yields. Over time, debt-to-GDP ratios declined. Savers received low real returns. Governments benefited from negative real rates. Today's system is more open. Capital moves globally. Markets react quickly. But elements of financial repression still exist. Regulatory requirements encourage banks to hold sovereign bonds as high-quality liquid assets. Pension funds allocate heavily to government securities. Insurance companies match long-term liabilities with sovereign debt. This creates structural demand. Structural demand supports borrowing capacity. Central banks also influence yield curves. Through quantitative easing, they purchase government bonds. Purchases suppress yields. Lower yields reduce government interest expense. This is indirect support. Even when quantitative easing slows, balance sheets remain large. The legacy effect persists. Now consider yield curve management. If long-term rates rise too quickly, governments face higher refinancing costs. Central banks can signal policy guidance to stabilize long-term expectations. Forward guidance influences bond pricing. Bond pricing influences debt sustainability. Financial repression does not eliminate debt. It reduces its real burden gradually. But repression has costs. Low yields reduce returns for savers. Retirees relying on fixed income may experience income compression. Capital may seek higher returns in riskier assets. Asset bubbles can form. Suppressed yields distort price discovery. Distortion builds misallocation risk. Another element is regulatory capital treatment. If sovereign bonds are treated as low-risk assets under capital rules, banks have incentive to hold them. This deepens domestic demand. Domestic demand reduces dependence on foreign buyers. Reduced dependence enhances stability. But concentration risk increases. If sovereign credit perception weakens, domestic financial systems feel impact. Financial repression is sustainable only if growth remains steady and inflation manageable. If growth stalls and inflation rises, repression loses effectiveness. Investors demand higher yields. Currency pressures increase. Capital may flow outward if confidence declines. The United States has an advantage. Reserve currency status. Global trade invoicing in dollars. Commodity pricing in dollars. Deep and liquid treasury markets. This creates consistent global demand. Foreign central banks hold treasuries as reserves. Global institutions require dollar liquidity. This structural demand provides cushion. But no advantage is permanent. Reserve status depends on trust in institutions. Trust in monetary policy. Trust in fiscal discipline. Trust in legal framework. If trust erodes, financial repression becomes harder to maintain. There is also a political dimension. Sustained financial repression requires coordination between fiscal and monetary authorities. Too much overt coordination may raise concerns about central bank independence. Perceived erosion of independence may increase inflation expectations. Inflation expectations raise bond yields. Higher yields tighten fiscal pressure again. The system balances on credibility. Financial repression works when subtle. When markets perceive policies as stabilizing rather than manipulative. Now consider the long-term arithmetic again. If debt grows steadily and interest expense consumes increasing portions of federal revenue, fiscal flexibility shrinks. Shrinking flexibility limits policy options during crises. Crisis response capacity weakens. Markets monitor this. If markets believe fiscal flexibility is narrowing irreversibly, risk premiums rise. Higher premiums increase borrowing costs. Borrowing costs accelerate debt growth. Debt growth increases perceived risk. This is the structural tension. The U.S. does not need to repay its national debt in full. It needs to maintain sustainability. Sustainability means debt growth aligned with nominal GDP growth. Interest rates below or near growth rates. Stable demand for treasuries. Controlled inflation. If these hold, debt can roll indefinitely. If these diverge persistently, pressure builds. Financial repression can smooth divergence. But it cannot override arithmetic indefinitely. Which leads to the final path. Restructuring. If not repayment, then what? If repayment through surplus is unrealistic. If inflation is constrained. If financial repression has limits. There remains one final path. Restructuring. For emerging markets, restructuring often means explicit default. Debt renegotiation. Haircuts. Maturity extensions. Currency devaluation. But advanced economies operate differently. Reserve currency nations rarely default outright. Instead, restructuring occurs indirectly. Through extended maturities. Through regulatory shifts. Through gradual erosion of real value. Through political negotiation. The United States is unlikely to declare default in a traditional sense. Treasury securities remain foundational to global finance. They serve as collateral in countless transactions. They anchor global reserve systems. An outright default would destabilize not just the U.S. economy but the global financial architecture. This is why restructuring in advanced economies is subtle. It is often disguised as reform. Tax reform. Spending reform. Entitlement adjustment. Monetary regime shifts. Debt ceiling negotiations. These political events influence market perception. Markets do not require perfection. They require predictability. As long as markets believe debt is serviceable, financing continues. The key variable is interest expense relative to revenue. If interest consumes too large a share of federal income, fiscal flexibility collapses. Collapse of flexibility reduces crisis response capacity. Reduced response capacity increases risk premiums. This is the threshold policymakers monitor carefully. Now consider demographics. An aging population increases entitlement spending. Healthcare costs rise. Pension obligations expand. Workforce growth slows. Slower workforce growth limits GDP expansion. Slower GDP expansion limits revenue growth. Revenue growth lags debt growth. Debt ratio pressure increases. Demographics amplify fiscal strain. There is also political polarization. Fiscal consolidation requires bipartisan agreement. Long-term sustainability requires consistency. Policy volatility increases uncertainty. Uncertainty increases bond yields. Higher yields increase debt service. The system is deeply interconnected. Restructuring, if it occurs, may not be dramatic. It may unfold through gradual tax increases, moderate spending adjustments, extended debt maturities, controlled inflation, regulatory incentives for domestic bond holding. Over time, debt stabilizes relative to GDP. Not through repayment. Through management. The critical insight is this. The US does not need to eliminate its debt. It needs to maintain credibility. Credibility sustains demand. Demand sustains financing. Financing sustains stability. The danger arises if credibility weakens significantly. If investors question sustainability. If inflation expectations de-anchor. If political dysfunction undermines confidence. If global alternatives to the dollar strengthen substantially. In that scenario, borrowing costs could rise sharply. Sharp increases in borrowing costs would accelerate debt accumulation. Accelerated debt accumulation would narrow fiscal flexibility. Narrow fiscal flexibility would limit policy options. The system would tighten further. However, the US possesses structural advantages. Large diversified economy. Global reserve currency. Deep capital markets. Institutional continuity. These reduce probability of abrupt restructuring. But structural advantage is not immunity. The arithmetic remains. Debt growing faster than GDP cannot continue indefinitely without adjustment. Adjustment may be gradual. Or it may be forced by market pressure. The phrase "cannot repay" does not mean imminent collapse. It means the model is perpetual rollover, not amortization. It means sustainability depends on growth, rates, and credibility. It means the system requires continuous management. Modern sovereign finance is a balancing act. Between inflation and stability. Between growth and discipline. Between political promises and fiscal reality. The US national debt is not a ticking bomb. It is a long-term constraint. And constraints shape economic futures quietly. The final question is not whether repayment will occur. It is whether sustainability can be maintained without triggering the collapse mechanism we described in the previous episode. Debt connects directly to liquidity. Liquidity connects to leverage. Leverage connects to confidence. Confidence connects to stability. The structure remains intact as long as confidence holds. And confidence rests on arithmetic, credibility, and coordination. The United States does not operate on a repayment model. It operates on a sustainability model. Debt is rolled. Interest is serviced. Confidence is maintained. Growth absorbs part of the burden. Inflation erodes part of the burden. Financial structure manages the rest. The system does not require zero debt. It requires trust. As long as investors believe treasury securities will be honored. As long as markets believe the economy will continue expanding. As long as institutions remain credible. The debt can grow. But it cannot grow infinitely without adjustment. The real constraint is not the size of the number. It is the relationship between debt, interest rates, and growth. If growth exceeds borrowing costs, sustainability holds. If borrowing costs exceed growth persistently, pressure builds. The path forward is not dramatic. It is incremental. Policy negotiation. Monetary calibration. Spending discipline. Revenue adjustment. Structural reform. The danger is not default tomorrow. The danger is erosion of flexibility. If interest consumes too much revenue, crisis response becomes limited. If fiscal space narrows, shocks become harder to absorb. Debt does not collapse systems by itself. It amplifies stress when combined with leverage and tightening. Which brings us to the next stage of escalation. Because sovereign debt is one pressure point. Artificial intelligence is another. And when investment euphoria collides with macro tightening, bubbles form. In the next episode, replacing humans with AI is going horribly wrong. we shift from sovereign sustainability to capital misallocation. If you want to understand how debt, leverage, liquidity, and speculative investment connect beneath the headlines, subscribe. Not for outrage. For structural clarity.